All right, all right. Good evening, everyone. Thank you all for being here today. I am so honored to have you share your evening once again with us on our Secure Your Wealth Building series. We do this about twice or thrice every month, talking about different aspects of business structuring, and what folks need in that regard. My name is Omolola Dike, and I am the founder of True Values Global Corporation. It's a business advisory firm that supports your business growth in terms of the type of structures you're using and the tax advantages and funding that you would need to proceed. So this evening, I am so excited to be speaking specifically about the LLC. That's the limited liability company. I have called this the LLC Blueprint, protecting the business, the owner, and wealth. So welcome. Today, we're focusing on one of the most commonly used and frequently misunderstood business structures in the US. Many people believe that once they file an LLC with the state, they have accomplished some things. We're going to be looking at the formation, the governance, tax planning, and wealth preservation of an LLC. So many people believe that once they file an LLC with the states, they have accomplished three things. They've protected their assets, and they have created a complete business structure. But that is not necessarily true. An LLC is a very powerful planning tool, but its effectiveness depends on how it is designed, operated, it's taxed, it's insured, and incorporated into the owner's broader wealth and estate plan. So my goal today is to help you all understand not simply how to form an LLC, but how to use one intelligently. So let's begin with the most basic question. What exactly is a limited liability company? An LLC is a legal entity created under state law. The owners are called members. This is different from a corporation where owners are shareholders, and different from a traditional partnership where the owners are partners. One of the major attractions of an LLC is that it's very flexible. An LLC can own property, operate a business, employ people, enter contracts, borrow money, hold investments, own intellectual property, and even own interests in other companies. It may have one owner or several owners. Fun fact about the LLC, it actually originated from Europe, from a country called Germany. This is where the LLC first took its roots. If you ever go abroad and you see the GmbH, it's a form of limited liability company as well. So the LLC may be managed directly by the owners of the LLC itself, or a management company or a management authority and it's given one or more managers. An LLC is a legal structure. It is not by itself a federal tax classification. These are two separate concepts. The distinction will we'll talk about the distinction later when we talk about taxation. So why has the LLC become such an important tool in wealth planning? Think of an LLC as serving several possible purposes at the same time. First, it may create a legal separation between the business and the owner. Second, it can help separate different types of assets and different types of risk. Third, it creates rules concerning who owns the company and who controls it. Fourth, it provides significant tax flexibility. And fifth, when coordinated properly with an estate plan, it can help address succession when an owner dies, becomes disabled, retires, or wants to transfer wealth. The mistake is assuming one LLC should hold everything. For example, if someone owns a successful operating business, a commercial building, and valuable intellectual property, we should at least ask whether these three assets should sit in the same entity. Should they be under the same umbrella? The broader wealth planning question is, where is the risk? Where is the value? Sometimes we want to separate these things. Do you have a question, Ms. Tammy?
Excuse me, Ms. Omalola, I apologize, but I think there's someone in the waiting room.
Okay, thank you very much. Just give me 1 second. Let's see, admit one guest. All right, thank you. Okay. Wonderful. Good evening, Mr. Lee. Thanks for joining us. So one of the principal reasons people like using LLCs is the liability protection. So generally, the LLC is responsible for its own debts and obligations rather than automatically making every member personally responsible. But limited liability should never be translated as no liability. That is not the case. An owner can still become personally responsible in several circumstances. For example, if the owner personally guarantees a loan, the LLC does not erase the guarantee. If someone personally commits a wrongful act, an LLC does not automatically protect that person from responsibility for their own conduct. Professional malpractice is another example. And courts may examine whether the business was actually treated as a separate entity. That is why good record keeping, separate accounts, proper agreements, insurance, and appropriate business conducts are so important. And the structure of that LLC, basically. So the LLC can create a shield, but you still have to maintain the shield. Now, there are several types of LLCs, as you see from the slide. I'm going to be talking about the components of LLCs generally, and then I'll touch a bit on the classifications as you see. So, what makes up the LLC? Let's break it down into its major components. First, we have the members. The members can be owners. As you see on the screen, although this is relating to taxation, there we have single member LLCs and we have multi-member LLCs. Second, depending on the structure, there could be one manager for the LLC, or there could be multiple managers for the LLC. And third, there's usually an organizer. That's the person who signs and files the formation documents. The organizer does not necessarily own the company. Fourth, there are formation documents that are filed with the state. So depending on the state, This may be called articles of organization or a certificate of formation. Now, the fifth, there's typically a registered agent or a designated address for legal notices. And finally, one of the most important documents is the operating agreement. This is where we move from merely having an LLC to actually having a functional legal structure. So the operating agreement is extremely important. All these different parts companies that we've talked about make up what is called the LLC. So you might file with the state, and the state has you put on an online form, and they call that an article of organization, and you feel, okay, I'm done. No, to be recognized as a functional business, you should also have what is called an operating agreement. The operating agreement really specifies how you want the business to be run. And for every LLC, that is always kind of different. So it's not all the time that it's the same. So I'm going to spend a bit of time talking about the operating agreement itself, because this is where many closely held businesses become vulnerable. The operating agreement is essentially the internal contract governing the company. It should answer certain questions before these questions become a dispute. So, who owns what percentage? Who contributed what? Who makes the decisions? What happens if a company needs more capital? Can a member sell their interest? What happens if a member dies? What happens if two 50-50 owners disagree? What happens if one person stops working but still owns half the company? Without an agreement addressing these issues, the owners may be forced to rely on the state default law or expensive litigation. A properly drafted operating agreement is therefore not just paperwork. It is a risk management document. The operating agreement should clearly identify who the members are and what each member owns. But ownership is more about percentages. We also need to know what each person contributed. Did one member contribute cash? Did one member contribute property? Did someone contribute intellectual property, equipment, business assets? Are there future capital contributions that will be required? Can a new owner be admitted into the LLC? These issues become specifically important in a multi-member company. A business relationship often begins with trust and enthusiasm. Now, the legal document should be written for the day when the owners disagree. We're not trying to be pessimistic. It's just a question of planning and planning ahead. Other things that are pertinent in the operating agreement are the voting rights and majority decisions. Who takes that? What does that look like? Who has what percentage of vote? What is a simple majority? All this is very important when we talk about the operating agreement. So, who controls the decisions in the LLCs? Now, it all depends on the type of LLC. So we're going to talk a bit about two types of LLCs that we typically see. I would say two or three types of LLCs that we typically see. The first one is the single member LLC. A single member LLC, from the term, has one owner. Now, there's a difference from a legal tax standpoint and a taxation tax standpoint. These are two different things. From a legal standpoint, the company exists separately from the owner under the state law. Now, for federal tax purposes, however, a single member LLC is generally treated as a disregarded entity until it elects another tax classification. So for many small business owners, that means the business activity is reported directly on the owner's personal tax return, the Schedule C. It's typically people have a Schedule C on their 1040 when they're the only member of their LLC. Now, one advantage of this is simplicity. There's generally no federal partnership income tax return simply because the owner created that LLC. But here is the important distinction. Forming an LLC does not automatically eliminate self-employment tax. That misconception appears frequently. The legal entity and the tax return are two separate questions. What are the best uses of a single member LLC? Now, a single member LLC may be appropriate for many business owners who have consulting practices, real estate holdings, investment activities, depending upon their facts. Now, as I said before, it is single member, it's owned by that person. It can provide an organizational framework while preserving relatively simple default federal taxation. But the owner still needs to operate it properly. The owner still needs to use a separate bank account, sign the contracts in the LLC's name, keep good accounting records, maintain insurance, document major transactions, and periodically review whether the default tax treatment is still appropriate as the business becomes more profitable. The only thing that may not benefit a single member LLC is that it's owned by that one member. So if anything goes wrong, if they are to be sued, let's take it, a mom baking cookies in her home, selling from her home those cookies, and someone says, oh, I got a tummy ache. I had medical bills from eating your cookies. I want to be compensated for my pain and suffering, which is a legal claim that they can bring. What is going to happen? They're going to look at everything that LLC owns. And because that LLC is tied to that one person, it brings all that person's other assets to play. And that's the danger of having a single member LLC. Now, what is a multi-member LLC? A multi-member LLC has two or more owners. By default, a domestic multi-member LLC with two or more members is generally taxed as a partnership for federal income tax purposes, unless other election is made. Now, the LLC typically files a partnership return, and the members receive information showing their share of taxable income, deductions, and other tax items. One of the attractions of a partnership taxation is flexibility. It can accommodate owners with different economic arrangements and may provide planning opportunities that are not available in every other structure. But the flexibility comes with greater complexity. You have capital accounts, allocation rules, tax distributions. You may have member loans and potentially self-employment tax considerations. That is why the legal documents and tax planning should be coordinated from the beginning. A multi-member LLC, the biggest risk is often not the taxation. It is the relationship amongst the owners. So imagine two friends start a business together. They each own 50%, and 5 years later, one wants to sell, the other does not. One works 60 hours a week, the other works 10. One wants to reinvest the profits, the other wants distributions. One gets divorced, one dies, one becomes disabled. These events should not be addressed for the first time when they happen. The operating agreement should anticipate them. That is why a multi-member LLC should generally have detailed provisions addressing transfers, buyouts, deadlock, death, disability, and valuation. Now, one fantastic thing about the multi-member LLC, though, that I would like you guys to take into consideration is the fact that if they're baking cookies, like I said, in their homes, the risk is shared. So instead of looking at, you know, and this is where the beauty of your own personal assets not come into play. When it's a multi-member LLC, they have to look at the LLC books because the LLC is separated from the owners in that regard. That is different from when it's a single member LLC. I'll touch briefly on a specific type of LLC that's really owned more by practitioners. So there's a professional LLC or a PLLC. So a professional limited liability company, commonly called a PLLC, is generally an LLC that's formed to provide certain licensed professional services where the state law permits. So these may be physicians, attorneys, accountants, architects, engineers. They have different types of, they are allowed to have what is called the PLLC. So when we look at the screen and look at the tax classification of the LLCs, for federal income tax purposes, the IRS considers the single member LLC as a disregarded entity. Profit loss made from that is filed on the 1040 under Schedule C. The multi-member LLC is deemed as a partnership. Now, we can elect, that is, change the status to either an S corporation, or a C corporation. So what can determine this if a business has already started and is already running? It's called tax planning. So when you have, it's even as a small business, it's good to meet regularly with not a tax professional, someone who understands tax strategies to really determine if you've crossed a threshold, and it will now be able to determine what would serve you better. Would it be to keep you as a single member LLC, or to elect to be an S Corp or a C Corp? So what are the functions of the LLC when it comes to wealth protection? One, the LLC, when it's properly structured, helps to separate business obligations from members' assets from the members' assets to the business assets. There's always control, management control. Owners define who runs the business, who signs the contract. The tax flexibility is also something that is very important. And as I said before, we can also elect to change the tax status depending on what we see fit. And also there's succession planning, which the LLC really, supports. So here we see the chart really gives us a bird's eye view of the structure that we just talked about. Single member LLC, under one state, a disregarded entity. The multi-member, we have the professional LLC, which could be one or more owners. And its default tax formation really just depends on the members. We also have the LLCs that can be taxed as S Corps or C Corps. Under state law, they're still recognized as LLC, but the IRS recognizes them differently. So what is the wealth protection formula for an LLC? It's very simple. You have to form it right, make sure it's governed properly, look and plan for the right tax treatment for that LLC, and also make sure that the LLC is properly protected. Before we close out and I open up to questions, I wanted to touch about 5 common mistakes, LLCs we could have with LLCs. First, someone forms an LLC but never adopts an operating agreement. That's one. Secondly, they mix personal and business funds. Third, they assume the LLC automatically creates tax savings. Fourth, they place too many unrelated assets and risks into one company without considering whether these risks should be separated. And then fifth, they never update the structure. A company formed when you had $50,000 in assets may need to look different when it holds 50 million. Imagine a single member LLC holding 50 million. It's a lovely apartment building, good renters, but everything is in that one box and somebody slips, falls. That's a huge payday for not only the person who slipped and fell, but the attorneys that are helping the person who slipped and fell. So I really like to encourage everyone to really look at how they're structured, especially because I know we use LLCs a lot. That's why I really wanted to talk about LLCs and break it down. They're a fantastic tool to have, but it's very, very important that we know that and we use them, use it properly. So I'm going to open up for questions. I'm going to first, close out the recording because I want to, make it for being here with us tonight. You get the privilege of we're spending some time together and diving on some things, And so I'm going to stop the recording. First, I'll stop share,